Hi, everyone. Welcome to Covenant Wealth Advisors' first quarter 2019 quarterly market review. My name is Mark Fonville, and I will be your host for today's presentation. To start, we're going to take a look at 6 key areas of market performance in the first quarter of 2019. We'll begin up top here with the market summary, just a very high-level review of market returns across stocks and bonds. Then we're going to take a look at world stock market performance and headlines. The headlines are what drives emotion within investors and can either improve or take away from your own personal performance. So that's a really important topic to discuss. Thirdly, we're going to take a look at world asset classes to really fine-tune performance returns across many different additional markets across the globe. Fourth, we're going to talk about the performance of different currencies. We don't talk a lot about currency, but it has a potentially big impact on your stock holding performance, particularly as it relates to international investment holdings. Then we're going to look at your fixed income or your bond holdings. That's more of the lower volatility or safer portion of your investment portfolio. And then finally, we'll take a look at the impact that diversification had on a diversified portfolio of indexes. So let's dive in and take a look at the first quarter of 2019. You'll see that pretty much markets across the board were positive in terms of performance. U.S. markets did the best. International markets did great. And global real estate did great. On the right here, you'll notice this is the bond portion. This is the portion of your portfolio that keeps balance within the portfolio. You can compare it to the shock absorbers within your car. Their purpose is really to lower the volatility. Sometimes they're not going to give you the returns that you want. But on the flip side, sometimes stocks won't either. They're just a little bit more consistent, lower volatility. But you'll see, surprisingly, that returns for bonds was really strong in the first quarter of 2019 as well. So we feel really good about that. But how does this compare to history? Well, we took a look, and going back to January of 2001, none of these performances for the first quarter of 2019 were the best since 2001. In fact, the trophy is taken in 2009, second quarter for U.S. stocks, international, third quarter for real estate, and then for bonds, you saw the best quarter in the fourth quarter of 2008 and then third quarter of 2001. On the flip side, wasn't anywhere close to the worst quarters that we've seen, which, of course, many of you remember 2008, and then worst quarter for bonds. Yes, a negative return. Bonds don't always produce positive rates of return. They came about in 2016 and 2015. This is a really important thing to understand with bonds, because I know some of the clients that we serve, sometimes you get jittery if you see flat returns with the bonds or negative returns, and you'll call us asking us, hey, should we go into cash or should we go into a CD? And I think that's really just looking at it in the short term. Over the long term, bonds tend to do what they're supposed to do. So we typically recommend stay invested, hold it for the long term, and those returns should come back. They're not guaranteed, but history has proven that they have historically. So moving forward, let's take a step back away from the short term and take a look at the 1-year, 5-year, and 10-year returns of markets. You'll notice in the 1 year, you actually had a little bit of negative return within international emerging markets. Some of you might be a little bit concerned about that. You might even think, gosh, Mark, should we get out of the market? Maybe we should go all into global real estate or U.S. stocks. And I would argue that actually seeing different returns within your portfolio means that you have a really well-diversified portfolio. You don't want everything to go up and down at the same time. And when different areas of the stock market decline like that, one way to look at that is it actually might be a really good opportunity to start investing in those areas. Remember, you want to buy lower and sell higher, not the opposite. As we go to the 5-year and 10-year, you'll notice returns start getting a little bit better. 10% for U.S. stocks over the 5-year. These are annualized returns for the index, emerging markets, and international. Pretty flat, right around bond-like returns for 5 years, right, for stock exposure. Again, that might frustrate some people, but remember, diversification isn't about trying to time the market. It's just capturing the returns wherever they may come. Since nobody knows where they'll come from, you need to own all the markets within your portfolio. And then again, bond market returns were good. Over the 10 years, equity stock returns have been fantastic. We really couldn't ask for anything more here. Again, international has underperformed U.S. markets, and that's just the nature of diversification. This happened actually on the flip side from 2000 to 2009, when U.S. markets actually didn't do well at all and international markets did a lot better. So those go back and forth. When you look at expected returns for stocks, both in U.S. companies and international, expected returns are similar across international and U.S. markets, maybe a little bit higher for emerging markets. So don't let any short or even long-term performance throw you on what to expect going forward. And then the bond markets, again, 3 to 4%, depending upon whether you in U.S. bonds or global market bonds. So a really great picture for investors over the decade. If you'd stayed invested, you would have hopefully, and been well diversified, hopefully you would have done well had you owned a nice diversified bucket of perhaps index funds. Going forward, let's take a look at the headlines that drove investor behavior. When you read the newspaper, when you read CNN.com or Fox News, all of these networks and newspapers, they're trying to do two things. They're trying to create fear and greed when you read their newspapers, because they want you to buy more and keep on coming back. And unfortunately, that can have a negative impact on your investment experience. Let's take a look at, for example, some of these headlines, right? You look, here, February 28th, rather, within the first quarter, U.S. economy grew 2.6%. Soon thereafter, the market started to decline. Over here, Fed keeps interest rates unchanged, signals no more increases likely this year. Seems pretty positive, right? But what's the hold in second, third quarter, or the rest of the year in 2019? Taking a step back, again, if we look at the 12-month picture for stocks, we can get a better idea of how media headlines may not be your friend over the long term. Take a look back. In the beginning of the year, first headline we see, yield on 10-year U.S. government bond hits 3% for first time in years. That could make bond investors jittery or happy. As interest rates increase, that tends to impact negatively bond prices, so may reduce bond returns. So what's to happen going forward? How about September 30th? U.S. unemployment rates fall to the lowest level since 1969. That's a pretty good sign, right? You might feel good about reading that headline, but what happened over the next couple of months? Stock markets declined. So that headline wouldn't have helped you. And then you get to the end of 2018 and you see that the headline, U.S. indexes close with worst yearly losses since 2008. What do? Do you stay invested? Well, of course, here's the first quarter of 2019. We know it was a good one. So in retrospect, it would have been a good idea to stay invested, which the vast majority of our clients did. Thank you. We owe you a round of applause really for that. And those who pulled out, unfortunately, it's going to be really difficult to make that money up. So stay invested, stay in it for the long term. Going forward, these are just different index returns for the first quarter in 2019. You can look at, for example, U.S. real estate did really well at over 15% return just in 3 months. The worst return, which really wasn't that bad, was a positive 0.58% with U.S. Treasury bills, hypothetically or theoretically the safest investment for investors. And then you have returns for indexes in between. So a diversified portfolio would have held much of the holdings of these indexes. Let's dive in a little bit to the topic of currency. So a lot of different countries have their own currency. Some peg their currency to the US dollar. But that fluctuation in their currency relative to the US dollar can have an impact on the returns of your international investments. So for example, when currencies strengthen versus the US dollar, for example here the British pound strengthened by 2.3%, investments that you have within Great Britain, actually that would have had a positive impact on those international investments for you, holding them here in the United States. So as the currency strengthened, that would have strengthened that portion of your investment portfolio. On the flip side, when currencies weaken relative to the US dollar, what you see is a negative impact on your national holdings. So for example, the Swedish krona dropped over 4% in the first quarter of 2019. If you own companies in Sweden, which we do, we own companies in most of these countries, it may have had a negative impact on your performance. And I think the point here is that a lot of things can impact markets, but oftentimes we don't think that just currency in general can impact the return on your portfolio. It may be unrelated to what's being talked about in the news. And we take that into account, and it's another reason to be really well diversified over time. How about fixed income or your bonds? Well, you've heard a lot about yield curves, normal yield curves, and you've also heard about inverted yield curves. What does that mean exactly? Well, first let's take a look. Interest rates have increased, or yields on bonds. You'll notice for U.S. Treasuries, 10-year, they're yielding about 2.4% as of the end of the first quarter 2019. AAA corporate bonds, very high-quality bonds, are yielding a nice 3.1%. It's a lot different than it was several years ago, so we feel good about that. This is the yield curve that you often hear about within the media on the news. A normal yield curve is actually this gray line here. And you'll notice that the shorter the maturity here, and this is yield on the left, on the bottom here is maturity of the bond. The shorter the term of the maturity of the bond, the lower the yield. And so as you increase maturity, the yield also increases. That's what's called a normal yield curve. However, recently we've seen an inversion of the yield curve. So you'll notice that shorter term bonds actually have higher yields than their longer term counterparts. And this might be distracting, it might be interesting. I don't think it's a real issue right now. However, some people say that a lot of the past recessions, there was an inverted yield curve prior to those recessions. But I would take it with a grain of salt and just understand, okay, yields have risen a little bit. They're a little bit higher on the shorter end of the curve. Everything looks fairly solid here for your portfolio. Okay. So what did the impact of portfolio or investment index returns have on a diversified portfolio? Well, in front of you is performance for a hypothetical portfolio of indexes with no fees included. And it just gives you an idea of how performance can be impacted when you increase or decrease stock exposure. So for example, look up here on the top right. Treasury bills, if you've been 100% invested in Treasury bills, you would have had just a slightly positive return at about 0.5%. Now, you may have been upset at that, or you might have felt good, but the reality is your returns are lower because you're taking lower risk. Risk and return are related, and that was the outcome, just a lower return relative to other types of portfolios. You'll notice a 50-50 portfolio here, which is a type of portfolio that a lot of our clients have, did about a 6.37% rate of return. That's really strong, really, really strong just within 3 months. And then had you been very aggressive, all stocks, potentially double-digit returns. So while this doesn't represent the performance of any of our portfolios, because all of our portfolios are custom, it does give you an idea of the impact of holding different amounts of stocks and bonds. Another way to look at this visually, in the bottom right here, is the growth of money over time since actually 1988 in these different types of index portfolios. You notice the 100% stock portfolio grew to a much larger sum over time, but it was much more volatile, whereas the much safer Treasury bill portfolio, which had much lower volatility, but much lower return. And so for a lot of investors, they can't afford not to take that risk. What ends up happening is they take less risk, but yet they run out of money because their portfolio doesn't grow and it doesn't keep pace with the rising inflation or cost of living. And that is all we have for you today as it relates to the 2019 first quarter in review. If you have questions, we'd love to hear from you. Just email us at info@mycwa.com. You can also call us at 888-320-7400. Again, my name is Mark Fonville. Thank you so much for joining us today, and we hope you have a good one. Take care.